We looked at phase one using the direct method. Now we're going to look through the phases using the step method or the stepwise method. So phase one is the same under both methods. We determine what our direct and indirect costs are and the type of usage across all departments. Where the step changes is in phase two. So in phase two, we step through the processes. Instead of just directly allocating those departmental costs based on percentage of use in the direct method, the step method allocates all of one department first and then allocates all of the second department based on usage. So you can see here that step one, first, we allocate all of department service one before we allocate department service two. You can reverse that. It doesn't matter which department goes first. It's just that one department is fully allocated to the other departments, and then the next service department is fully allocated to all of the other departments. Then we allocate to the two products. This is also the same as the direct method, phase three of that component. In the reciprocal method, we recognize that there is a reciprocal relationship between all departments. Phase one is exactly the same. So much like the step method and the direct method, where we're going to see the changes are in the phase two. So in the reciprocal method, we use this analysis where we replace information about each department into a set equation. So we show that traceable costs and costs allocated from the service department two are percentage amounts. So we see traceable costs plus costs allocated from two. So step service department one gets their own cost plus 10% of service department two. And service two is their own cost plus 40% of service department one. The reciprocal method is the most difficult method to calculate. Therefore, it is also considered the most accurate for true cost reflection. Then we look at allocating to the production departments. So we're going to allocate based on the production use. This is similar across all different methods. And then phase three, where we allocate it to both products, also matches all three methods: direct, step, and reciprocal. We will, of course, practice all three of these methods in class. What implementation issues that we have is that wide variations can occur in the product allocation amounts. So we really want to make sure that we're choosing the method that really shows a cause and effect relationship. We have incentive to increase usage on one or the other. Okay, it's unfair to just to allocate based on unrelated to usage, because then different departments are going to take more than their fair share. There are a lot of internal organization politics around how these allocations happen. And much like anything else, there's no hard, fast, it has to be done this way rule. So when we're looking at getting rid of this disincentive problems, one is that we can use dual allocation, separating variable and fixed costs and tracing the variable costs directly to the departments that caused the cost. We can also use budgeted amounts rather than actual amounts to make the allocation of fixed costs more predictable and less dependent upon the usage of other departments. So we would use an allocation rate to allocate service department costs. Allocated costs can exceed external purchase costs. So occasionally we might allocate to a department for a product or service that exceeds the cost of purchasing that item for an outside supplier. This gives the purchaser the incorrect incentive to purchase outside the company. So this is when we've allocated the costs from service departments in such a way that we would actually be better off financially if we outsource. We don't want to create this disincentive problem with our employees and our purchasers. We don't want to allocate costs in such a way that we force them to find outside suppliers instead of using internal resources. The next thing that we're going to talk about in Chapter 7 is joint products. Joint products are things that can be created from a common resource input. So this is called joint production process. Joint products have a joint production process and a split off point. Okay? They have relatively substantial sales values, so that there becomes a point in the production where we can split off and choose to make different products. And what the results from those products are due to our profit margin is what we want to analyze when we decide what to send our resources to. For example, if we process lumber, we can do a variety of things with that lumber. We can make 2x4s, we can make different construction components, we can even produce for paper mills. So there's a wide variety of things that we can do. But the very first step in the process is getting the lumber in, clearing it, and preparing it to become a construction product. Then, when we have products that exist as part of this joint processing, but they have a relatively minor value, they are called byproducts. An example of a byproduct would be wood chips that just naturally occur when we process lumber. So wood chips just happen, and they have a minor cost and sale value as compared to different product options that we have. So joint products and byproducts all start as the same raw material. And up until a certain point, there's no difference between what our end products are. That point in a joint production process where we must make a decision about what products we end up producing from our raw materials is called the split off point. There are multiple ways to calculate for these joint costs and to make determinations about what we do after that split off point. So we have 4 methods to allocate joint product costs: physical measures, sales values of the products that split off, the net realizable value of the products, and the constant gross margin percentage method. So the physical measure method just uses the physical measure of output, such as pounds, gallons, units, and allocates joint cost products. The greater the output, the greater the share of joint costs allocated to that product. This method is also called the average cost method when units of output are used in the costing procedure. So looking at this example, we have seafood products that can do tuna fillets or canned tuna from its unprocessed tuna. So in point one, we have this unprocessed tuna. Then we need to make a decision about how much we turn into fillets, how much we produce as canned tuna, and how much becomes byproduct scrap and waste. So we see here from the process that 14,000 pounds of unprocessed tuna are total, and then we can split off into 2,000 pounds of tuna fillets, 8,000 pounds of canned tuna, or 4,000 pounds of byproduct scrap and waste. So we would divide our total cost by the total pound amount and apply that to our split off point. So in that example, we have $16,000 in joint costs. So that's the process of production until we get to the split off point. 20% of that gets allocated to the tuna fillets and 80% gets allocated to canned tuna.